my former life, I was an analyst at a hedge fund. You can imagine a lot of people are asking me questions about what's going on with Gamestop and what is shorting and what is a hedge fund. So I thought I would just try to answer as many questions as possible in a video, and then I'm happy to answer more, any other questions that y'all have. So I'll start at the basics. A hedge fund really is an investment management firm that has more flexibility than, say, a mutual fund. And the trade-off here is that a mutual fund can market to practically anyone, but because of that, they are heavily regulated in terms of what they can invest in and how they can invest. Hedge funds can take funds from and market to a much narrower group of people, mainly institutional investors or high net worth individuals. And because of that less regulation, they're allowed more flexibility in what they do. Now, the hedge fund universe is very, very, very diverse. There are hedge funds that use that flexibility to actually take on less risk. There's hedge funds that do very classical forms of investing. There are ones that are doing classical forms of investing, but they're hedging by buying some stocks that they think are stronger and then selling short other stocks that they think are weaker. And I'll explain what short selling is in a bit, but that kind of long short investing is a way of saying, okay, we're going to take out the market risk, so to speak. And then there's hedge funds that do, I would argue, far riskier things, going into much more aggressive things. They're using that flexibility to get leverage to kind of magnify the impacts of their trades to the upside or the downside. So hedge funds are a very broad category of essentially investment managers. In terms of what short selling is, at a very high level, I think most people are getting this, it's a bet that something will go down. And when you normally buy a stock, your intent is to buy low and then sell high, and then you make a profit on the difference. When you're shorting it, you're doing it in the opposite order. You are selling first, and then you're going to buy later. And I'll explain in a second on how that is done. But in theory, let's say if a stock is at $10 per share and you're able to sell it for $10, so you get the $10, and then later, if you're able to buy it at a lower price, let's say it goes down to $2, then you're able to net $8. Now, if the stock goes up, you could lose money. In fact, you can lose an infinite amount of money. Now, the mechanics of how shorting works, you're like, how can that be possible that someone can sell something before they buy it? Well, the way that happens is they borrow it, sell it, and then later when they have to return the shares, they buy the shares back and then return it to whoever they borrowed the shares from. And I know that can be a little bit complicated, this notion of what does it mean to borrow shares? And I'll give an analogy. Imagine that you have a car in your driveway that I know you're not driving, but you own it. And I am very confident it's going to depreciate a lot over the next few months. And I know you're not going to drive it over the next 6 months. Maybe you're going to go on a vacation or something. So I go to you and I say, hey, can I borrow your car? And I'll return it back into your driveway, the exact same mileage. I'm not even going to drive it. And you're like, sure, okay, you can borrow it if I have the exact same car back in my driveway in 6 months. And so I borrow it and then I sell it. Let's say I sell it for $10,000. And then before you come back from your vacation, I buy an identical car with identical mileage, maybe that car, or maybe just another car that's identical to it. And I buy it for $8,000 and I put it into your driveway and you don't notice the difference. Well, to you, you're just like, I had a car before, I have a car now, it's an identical car. But I was just able to capitalize on the depreciation of that car, thinking it would go down. Now, of course, if there's a craze in that car and everyone wants to buy that car used, I guess. And let's say before you come back from the vacation, if to buy that car back, I have to spend $15,000, well, then I would have just lost $5,000. And you can imagine, cars can only get so expensive, but stocks can get arbitrarily expensive. So inherently, shorting is very risky. If I buy a $10 stock, the most that I can lose is the value of the stock. The most that I can lose is $10. If I short a $10 stock, the most that I can make is $10 if the stock goes to zero. But the most that I can lose, well, it could be an infinite amount. If the stock goes to 100, I could lose $90. It's per share that I'm betting on. If the stock goes to 1,000, I could lose $990. So shorting can be a pretty risky game. Now, to explain what is happening with GameStop, or what is a short squeeze. So you have a company, GameStop, kind of a traditional retailer that's in a space that I think most people think is probably a dying industry of physically selling video games at a mall. Most people are downloading video games or buying them online in some way, shape, or form. On top of that, they're struggling because all retailers are struggling now because of COVID restrictions. And so many hedge funds decided to take a short position. So they would go to their brokerage and they'd say, hey, can I borrow some GameStop stock? And brokerages make good money on this. They charge a little bit in order to borrow that stock. And so they're going to find another client that owns the stock, borrow it from them, and then let the hedge funds borrow it. And then the hedge funds will sell that GameStop stock. And then arguably they're waiting for that stock to go lower, and then they'll buy it back and then return it to the brokerage, who will essentially return it back to the person who owns its account. Now, what's happened in GameStop, and we have this whole Wall Street bets factor from Reddit, but you have this dynamic where you have a new generation of retail investors coming in. They're getting coordinated on sites like Reddit, on threads like Wall Street Bets, and they're saying, hey, there's a lot of people who have shorted GameStop. The technical term for it is it has a high short interest. So a very large percentage of the shares of GameStop have been shorted. I actually think it was over 100% at a point, which is a little bit, that's a whole other conversation of how that can happen. But they said, well, if we start buying GameStop, then these hedge funds are going to have to cover their positions. And the way that happens is, imagine a bunch of hedge funds have shorted GameStop at let's call it $10 a share, just to make the math easy. And now if people start buying it, that will drive the price higher and higher, especially if there's more demand than maybe people who are looking to sell it. So they're starting to drive the price higher and higher. And as that price goes higher and higher, those short positions are losing money. Now, a lot of the hedge funds might have kind of a strong hand and say, okay, you know what? We can take these losses for now. We have conviction in the future. The stock will go down. So on our books, it might look like a loss, but we can kind of hold the fort. But some of the hedge funds might have overextended themselves. And as that stock goes from $10 to $15 to $20, their brokerage is going to say, hey, I don't know if you're good to cover this short anymore. I want you to unwind this position right now. Because if this keeps going up, you might go out of business and then we're not going to get our stock back. And so those, let's call them the weaker hedge funds, are going to have to unwind their position at a loss. They sold at $10. Now they might have to buy at $15 or $20. So they're going to take a loss. But now they're going to buy and drive the price up even more. And then you're going to have a whole other, more hedge funds with slightly weaker hands or slightly less weak hands who are going to have to unwind their position at a loss. And that's going to drive the price higher and higher and higher and higher, all while you have some of these kind of retail investor groups that are saying, let's buy this thing, which drives the price higher and higher and higher and makes the short squeeze happen in a more and more accelerated way. Now, we can debate what's good, what's bad. I will say there's legitimate reasons why someone might want to short. It might hedge some risk. It actually creates some positive information in the broader market. It gives an incentive for people to kind of dig into companies and to see if their businesses are sound or whether there's something shady. But there's a lot of risk. And, one of the factors that's developed recently is it looks like Robinhood stopped people from continuing to buy shares of GameStop. And they're giving a kind of a wishy-washy argument about they want to protect investors and their users and all of that. But, they've definitely not invoked that in the past when their users were doing reasonably risky things. And so it's not clear why they did that. But the problem is that it looks like that's being done to maybe protect or mitigate the short squeeze somehow. And, the reason why it raises suspicions is, where Robinhood might get its revenue from, because it doesn't charge commissions to its actual people trading. Some of it is actually by lending securities to people who need to borrow it, doing this, allowing people to lend their securities or borrow securities from other people. There might be other business models that might be more connected to people who do not want the short squeeze to happen. I do not really know what's going on there. My general view is, being able to short something, there are some legitimate reasons to do it, but if you're doing that, you also have to allow people to take the losses. And as we can argue all day whether this is rational or irrational, how much is GameStop worth, et cetera, but I do think it is healthy for, in a properly functioning market, for some of these short squeezes to happen, because it will be a bit of a warning sign for people in the future to kind of be a little bit more careful when you're shorting things, especially with a high short interest. It's also it's kind of a Darwinian effect on hedge funds that essentially have taken too much risk on they might not exist, but the ones that have been able to manage their risks better will be around and be able to get through this.